Let me tell you something that took me years to fully understand. And I say this as someone who has personally sat across the table from executives who design these exact systems for a living. In 2024, American consumers paid $12.1 billion in overdraft and non-sufficient fund fees alone. And the most disturbing part of that number is not its size, but the fact that roughly 9% of all account holders were responsible for generating nearly 80% of that entire revenue pool, meaning the banking system is not extracting money uniformly from everyone but is instead identifying specific psychological profiles and extracting from those exact individuals repeatedly through a mechanism that is not accidental and not the result of consumer carelessness, but is the product of decades of deliberate behavioral research conducted inside the most capitalized institutions on Earth. JPMorgan Chase, which now holds over $3.5 trillion in total consolidated assets, making it the single largest bank in the United States, collected $1.028 billion from overdraft fees alone in 2024, and Wells Fargo, sitting at $1.9 trillion in assets, collected $1 billion from the identical source, meaning those two institutions together extracted more than $2 billion, specifically from consumers already living at the financial margin, because 16% of Americans earning below $25,000 annually paid overdraft fees in 2024, compared to only 6% of those earning above $100,000. That disparity is not a demographic accident. It is a designed outcome, and understanding precisely how it gets designed, what mechanisms produce it, and which cognitive vulnerabilities it exploits is the only thing that will allow you to stop being a predictable participant inside it, which is exactly what the system needs. You to remain in order to keep generating those numbers. The system is not new, and it did not emerge from neutral market forces. It was built piece by piece through research grants, product testing cycles, behavioral consultants, and the quiet institutional knowledge that accumulates inside organizations, managing trillions of dollars and employing the most quantitatively sophisticated workforce in the history of commerce. Organizations that have been refining their understanding of your decision-making architecture continuously for longer than most of their current customers have been alive, and that are considerably better at predicting your financial behavior than you are. There is a concept in neuroscience called the pain of payment. And when researchers at MIT and Carnegie Mellon first formally documented it, they discovered something that the banking industry subsequently turned into a core product design principle that has shaped every major payment instrument introduced since. Paying with physical cash activates the insula region of your brain, the same neural region that registers physical discomfort and social rejection, meaning that handing over a $20 bill literally produces a neurological signal closely resembling mild pain. And this signal is not a flaw in your psychology. It is an evolutionary mechanism that exists specifically to prevent overconsumption by applying a biological break at the precise moment of financial outflow to make you pause, reconsider, and potentially not spend. Now consider what Visa, MasterCard, and the major banks issuing their products spent the last 4 decades systematically building. Every tap-to-pay terminal, every stored card credential in Amazon's checkout, every one-click purchase button, and every Apple Pay and Google Pay integration was designed around one measurable central goal: eliminate that neurological break as completely as possible. The word the fintech industry uses for this engineering outcome is frictionless, and you will find that word in every major bank annual report, every payment processor investor presentation, and every product launch statement from companies including Square, Stripe and PayPal without exception. Frictionless sounds like a consumer benefit because it describes an experience that feels easier, and things that feel easier are things we do more often. And things we do more often generate more transaction volume, and transaction volume is precisely the metric that drives interchange revenue for every card-issuing institution in the world. So the frictionlessness is good for the consumer in the same narrow sense that a casino carpet designed to reduce fatigue is good for the gambler. This is not a conspiracy theory. It is a documented engineering choice reflected in every frictionless payment patent filing, every checkout optimization study, and every mobile payment adoption report published by the institutions themselves. The pain of payment was the last biological protection consumers had against the behavioral manipulation that modern finance deploys at scale, and the industry spent decades and billions of dollars removing it, not because consumers asked them to, but because the transaction data told them clearly that removing it made people spend more. In 1986, a researcher named Richard Feinberg ran a controlled experiment that almost nobody in the general public has ever heard of, but that every major credit card company knows in precise detail because the finding of that experiment became a foundational design input for the entire modern payments industry. Feinberg brought participants into a room, showed them a set of consumer products, and asked them to state how much money they would be willing to pay for each item using cash. Half the rooms in the experiment contained visible credit card logos displayed on the walls as ambient environmental elements. The other half did not. The participants sitting in rooms where credit card logos were visible consistently offered significantly more money than participants in logo-free rooms, and this spending premium appeared even though no credit card was involved in any transaction because the experiment used cash throughout, meaning that just the visual symbol of the payment system altered what people were willing to pay for identical goods under identical conditions. That finding has been replicated across dozens of independent controlled studies since 1986 and is now called the credit card premium in behavioral economics literature. Now, consider where you encounter credit card logos in your daily life. They appear on every checkout page of every commercial website, on every point-of-sale terminal at every retailer from a major chain to a local coffee shop, in every mobile banking application you open, and in every piece of marketing communication your bank sends you. Bank of America, with over $2.5 trillion in total assets, places its card branding at every consumer touchpoint. Not from branding tradition, but because visual conditioning modifies spending. Behavior at a neurological level, operating below conscious deliberation, and Citigroup and HSBC maintain behavioral design teams whose documented purpose is ensuring that the visual environment of their products sustains the psychological associations that increase transaction frequency. What Feinberg proved, and what every subsequent replication confirmed, is that the bank does not need you to be using your card to influence what you are willing to pay for things. It only needs its symbols present in your environment. And given that those symbols are now embedded in every digital surface you interact with throughout your day, the conditioning is effectively continuous, operating without your awareness and without any disclosure that it was deliberately engineered. Let me show you a specific number that almost no consumer has ever consciously examined, but that every bank product team knows with precision and deploys with intention. When you receive your monthly credit card statement, there is a minimum payment figure printed on it, and research published in the Journal of Economic Psychology in 2009 by behavioral economist Neil Stewart showed that this Number functions not as a floor for your repayment decision, but as an invisible psychological ceiling that actively suppresses how much you actually pay back. In controlled experiments where the minimum payment line was removed from hypothetical billing statements entirely, consumer repayment amounts increased by 70%, meaning the number printed by the bank as what appears to be a helpful piece of consumer information was in practice, reducing the repayment behavior of every consumer who read it, anchoring their monthly payment decision around the bank's preferred outcome, rather than around the consumer's own financial interest. This is the anchoring bias first formally documented by Daniel Kahneman and Amos Tversky in their landmark 1974 paper on cognitive heuristics and judgment under uncertainty. And it describes the human tendency to allow the first number encountered in any decision sequence to disproportionately dominate all subsequent judgments in that sequence, regardless of whether that first number has any logical relationship to the decision being made. Capital One, Discover Financial Services, and American Express all employ behavioral economists in advisory or staff roles, and the minimum payment figure that appears on your statement is positioned where it is, displayed in the font size it is, placed before the total balance disclosure and before the interest rate information, precisely because of what 4 decades of anchoring research demonstrated about how the sequence of numerical information presentation controls financial decision-making at a level that deliberate, conscious reasoning rarely overrides. The sequence of information presentation is not chosen by accident at any institution managing hundreds of billions in receivables. Every element of your billing statement was placed where it is because someone at the institution tested multiple arrangements against actual consumer behavior, data, and selected the arrangement that produced the financial outcome the bank preferred. The statement you receive is not a neutral communication of facts. It is a behavioral intervention designed to produce a specific response from you, and that response is not the one that serves your long-term financial interest. The rewards program is the most structurally elegant piece of behavioral engineering in the history of consumer finance, and I want to be precise about why it works at the level of mechanism rather than at the level of marketing, because the marketing explanation and the actual explanation are entirely different things. Nobel Prize-winning economist Richard Thaler proved through decades of experimental research that humans do not treat all money as fungible and interchangeable. We categorize currency into separate, psychological accounts in ways that prevent accurate comparison across those accounts, and different mental accounts respond to different emotional signals. So gains in one account do not offset losses in another even when the dollar amounts are mathematically equivalent. Banks exploit this with rewards programs by creating a points currency that exists in a completely separate mental account from your actual dollars. So when you spend $100 to earn $2 worth of cash back, your brain does not calculate a 2% return on expenditure and weigh it against available alternatives. Instead, it registers a gain in the rewards mental account and a separate spending event in the dollar account, and the comparison that would reveal the actual economics of that exchange never gets made. Chase Sapphire, American Express membership rewards, and Citibank thank you points are all built on this mental accounting architecture, and the Vanderbilt Law Review documented in October 2025 that the intermittent reward structures in these programs produce identical psychological effects to slot machine reinforcement schedules, where consumers continue engaging primarily to avoid the feeling of having wasted previous effort rather than from a rational assessment of future value. The entire ecosystem is funded by interchange fees between 1.5 and 3% that the bank collects from every merchant, fees that merchants embed into shelf prices, meaning cash-paying consumers at Target and Walmart are partially subsidizing rewards they will never personally receive. The points themselves can be devalued at any time without your consent, because the terms of every major rewards program reserve the right to change redemption rates unilaterally, meaning you are accumulating a currency that the issuing institution controls entirely and can inflate or deflate according to its own profitability requirements, which the loyalty trap analysis confirmed is precisely how the final extraction phase of every major loyalty program has historically operated. In 2008, behavioral economists Richard Thaler and Cass Sunstein published the foundational research introducing choice architecture to mainstream discourse, demonstrating through carefully documented evidence that how options are physically arranged and presented to a decision-maker determines which choice gets made far more powerfully than the actual merits or financial characteristics of the available options, and the banking industry absorbed that research and applied it at industrial scale throughout the following 15 years in ways that the original researchers have since publicly expressed concern about. The most powerful instrument in choice architecture is the default option, because behavioral research consistently shows that people accept whatever configuration is pre-selected at rates dramatically higher than they would actively choose that same configuration if it were presented as one option among equals rather than as the starting point requiring effort to change. Banks have ensured that the default setting in virtually every account, enrollment process, every digital onboarding flow, and every product activation sequence is the specific configuration that maximizes bank revenue generation rather than the configuration that serves consumer financial health. And these two objectives point in opposite directions with enough regularity that the distinction matters enormously. Opting into overdraft protection is the default at most major institutions, meaning consumers who move through account setup without reading and modifying every pre-selected option end up enrolled in a fee-generating program they never consciously selected. The Consumer Financial Protection Bureau documented precisely this dynamic in its overdraft research, showing that the framing of the enrollment question determined consumer outcomes more powerfully than the consumer's actual underlying preferences. Goldman Sachs applied these identical principles when designing the Marcus consumer banking product, and Morgan Stanley and BlackRock embed equivalent choice architecture in their wealth management interfaces, ensuring the path of least resistance always leads toward higher revenue products. What the choice architecture literature makes clear, and what institutions deploying it are careful never to communicate to their customers, is that the default is not a starting point, a neutral party, selected because it seemed reasonable. It is the end point that the institution determined would generate the most revenue if the consumer did nothing to change it, which means the consumer who accepts defaults is not making a passive non-decision. They are actively being steered by a system that has already decided where it wants them to end up. Loss aversion is the most robustly replicated finding in all of behavioral economics, establishing through hundreds of independent studies across dozens of countries that humans experience the pain of a financial loss at approximately twice the emotional intensity of the pleasure produced by an equivalent financial gain. And the major financial institutions of the world have engineered every promotional structure, every offer expiration, and every product communication around this asymmetry with a precision that most consumers never consciously register. because the exploitation does not feel like exploitation when it is expressed as concern for your financial well-being and opportunity. The introductory offer is the purest deployed application of this principle in retail banking. When American Express offers a 0% APR for 15 months, the communication architecture around that offer frames it not as a new benefit beginning, but as an existing benefit approaching expiration. Because the imminent loss of something you currently possess activates loss aversion at double the emotional intensity that gaining a new equivalent benefit would produce. Citibank's balance transfer offers work identically, presenting debt consolidation as the elimination of an existing financial pain, and research on actual balance transfer behavior consistently shows that consumers who execute these transfers do not reduce total credit utilization in the following 12 months but maintain or increase it, because psychological relief from addressing existing debt removes the motivating discomfort that otherwise drives sustained repayment discipline. Fintech companies including Affirm, Klarna, and Afterpay, which together processed hundreds of billions in buy now, pay later volume through 2024, are built on this identical cycle of loss aversion and relief, targeting consumers at moments of apparent financial resolution to introduce new credit obligations framed as empowerment and flexibility, rather than as debt with a different label. The complete picture of how loss aversion is deployed across the financial services industry reveals a consistent pattern. Every product introduction is framed as the elimination of an existing pain rather than the creation of a new obligation, and every credit limit increase is framed as expanded freedom rather than expanded exposure to the exact psychological mechanisms that generated the balance you are currently carrying. The framing is not incidental to the product. The framing is the product. The mobile banking application is the most behaviorally information-rich environment that financial institutions have ever had continuous access to, and what it enables is not personalization in the benign consumer-serving sense, but precision, targeting of psychological vulnerability at specific identified moments in your financial life cycle that you yourself have not yet consciously recognized. Before smartphones existed, JPMorgan Chase could observe what you spent, where you spent it, and when you made repayments, which is a relatively coarse behavioral profile. With a mobile application that you open multiple times every week, the institution can now observe how long you spend looking at your balance before closing the screen, what time of day you check your account, which product features you examine without using, and how your transaction patterns shift in response to different notification types and timing sequences. Ant Group, which operates Alipay and serves over 1 billion users, has documented that behavioral prediction models built on mobile usage. Data can identify financial stress indicators weeks before those indicators manifest as missed payments, and Western institutions, including Capital One, which invested heavily in machine learning infrastructure throughout the early 2020s, apply equivalent predictive capabilities to the timing and targeting of product solicitations. A consumer identified as experiencing financial stress 3 weeks before they would self-identify as needing help is statistically more likely to accept a high-interest personal loan at terms they would reject when financially stable and psychologically calm. Every element of every banking interface you use was optimized through continuous A/B testing against behavioral data, and the objective function driving that optimization was revenue generation, not consumer financial health, because those are two separate and frequently opposed goals that no institution is currently required to reconcile. in your favor. The regulatory frameworks governing what behavioral data banks can collect, how they can use it for product targeting, and what disclosure obligations exist when predictive models identify vulnerable consumers for high-margin product, offers remain significantly underdeveloped relative to the sophistication of the targeting systems currently deployed, creating an information asymmetry between the bank and the consumer, that is, from the institution's perspective. The competitive advantage its technology investment was designed to create and maintain. Switching costs are the least discussed but most durable retention mechanism in the bank's long-term behavioral strategy, because a consumer who would rationally benefit from moving their accounts to a competing institution will frequently remain with their current bank, not from product satisfaction or loyalty in any meaningful sense, but from the accumulated weight of effort and uncertainty involved in executing the transition. And the bank designed that accumulated weight incrementally through every linked product, every automatic payment arrangement, and every stored credential added to the account relationship over time. Present bias, the documented human tendency to heavily discount future benefits relative to immediate costs, is the specific cognitive vulnerability being exploited here, and banks ensure it works by making the process of switching sufficiently sequential, documentation-intensive, and disruptive to existing automated financial arrangements that the brain's natural temporal discounting consistently evaluates staying as the rational choice even when a straightforward calculation of fees paid, interest earned, and services received would clearly indicate otherwise. The natural experiment in the United Kingdom after the government legislated banking portability through the current account switch service provides direct evidence of how much of the banking industry's customer retention is built on friction rather than satisfaction. Because when regulatory intervention removed the switching difficulty, customer movement between institutions increased measurably, and banks that had claimed superior service found retention numbers declining, revealing that what they called customer loyalty was in substantial part engineered inertia. HSBC, Santander, and Standard Chartered apply identical principles across their global retail operations, and every bank in every market claiming low churn reflects product quality is making a claim that the United Kingdom experiment directly contradicts. The switching cost architecture also explains why so many consumers remain with banks they openly describe as unsatisfying when surveyed, and why customer satisfaction scores in retail banking correlate so weakly with actual customer retention rates. The product does not need to be good enough to retain customers. It only needs to make leaving feel worse than staying, and after years of accumulated automatic payments, linked accounts, and stored credentials, the infrastructure of leaving has been quietly built into something that feels genuinely prohibitive even when the financial case for leaving is entirely obvious. Everything I have described across these 9 scenes converges on a single conclusion. I want you to carry forward, because awareness is the one variable in this entire equation that exists entirely within your control, and that the complete system is, specifically and deliberately, designed to prevent you from ever developing at scale. The $12.1 billion extracted in overdraft fees in 2024, the $149.4 billion in yield enhancement, products sold to consumers chasing returns. They cannot mathematically evaluate the rewards ecosystems funded by merchant interchange, fees that consumers never see and therefore never factor into their calculus, the minimum payment anchors that research showed suppress repayment by 70%. The loss aversion triggers that convert balance transfers into higher total debt loads rather than lower ones. The mobile interface is optimized through continuous behavioral testing for revenue generation rather than consumer, financial health. All of it operates through the same single underlying mechanism, which is the gap between how your brain actually processes financial decisions under real-world conditions of complexity, time pressure, asymmetric information, and emotional state, and how you believe your brain processes those decisions. When you imagine yourself as the rational and fully informed actor that economic theory assumes you to be. Warren Buffett has observed repeatedly that the financial industry profits most from activity rather than from outcomes, from the velocity of money moving rather than from money held productively still. And the behavioral architecture described across this video is simply the mechanism through which that activity is generated by engineering the psychological conditions that make spending feel natural, rewarding, and even virtuous while making deliberate saving, careful comparison, and patient inaction feel psychologically inadequate and socially insufficient. Understanding the mechanism is not the same as being immune to it, because these biases are not beliefs that can be corrected through information alone. They are features of how human cognition operates under conditions that the financial industry has become expert at constructing. But understanding the mechanism changes the relationship between you and the system from one in which you are an unknowing participant, generating predictable outcomes for institutions that know exactly what you will do next, to one in which you are at minimum an informed participant who can recognize the trigger before it fires, which is not a perfect defense but is the only one available and is considerably better than remaining precisely as predictable as the $12.1 billion overdraft revenue line suggests most Americans currently are.